Okay, hello everybody, and welcome to this introductory lecture, the first lecture of this year for PRS. Just before we get started, I just want to give you a bit of an orientation with respect to how this recording is going to work so that you're not surprised. First of all, I'm obviously sitting in a recording studio staring at a camera, which is slightly unusual. However, I have my laptop, which is right here in front of me, so my gaze throughout this presentation is going to be towards the laptop, and maybe not always staring into the camera. The setup and orientation for this video is that you should be able to see on the screen myself as well as the PowerPoint presentation on a split screen. Okay, the slides are available on Ulink, so you can download those and go through them as well while you watch this video. There are certain instances and times during the video where I'm going to ask you to pause the video and perhaps do some sort of activity or do something. Please follow my instructions and do as I say, so that we can maximize how much information you're able to take in and retain. Okay. In addition to the PowerPoint slides, I've also made available a risk register, which is a Microsoft Excel document in the same lecture folder. So I want you to download that if you haven't done so already. Maybe this is a good time to pause this video and download that PowerPoint document, because you will need it towards the end of the video. Okay, so let's get right into it. The purpose of today's lecture is to give you an introduction to risk and risk management. Okay. Just to talk around the lecture just a little bit, it's a very important lecture for a couple of reasons. Okay, I think the most important reason is that most of you are new to the idea of risk management. Okay, depending on your background, you would have come across a variety of risks or the concepts of risk, but I don't think that any of the courses that you've done in your undergrad studies will compare to the depth of the course that you're going to do here, which we've already discussed during the induction program. Okay, so this lecture is meant to give you an orientation, okay, to introduce you to new concepts and new ideas, and basically talk you through and help you understand what it means when people say that they are managing risks. And obviously, to understand that, we also need to understand what in the world a risk is in the first place. Okay, so in addition to that reason, so this lecture is also important because it basically sets the foundation for all the other areas that we're going to be doing or looking into as the year progresses. Okay, so if you don't understand some of the definitions, if you don't understand some of the language, some of the concepts that are used from this lecture, it's going to become difficult for you as we move forward. Okay, what are the learning outcomes for this lecture? So first and foremost, the broad learning outcome is that we want you to learn how to identify, classify, and evaluate a risk, and I'll get into some of these ideas and what they mean as we go through the presentation. I want you to learn how to evaluate the types of risks that face an organization and develop the ability to respond to those risks by recommending appropriate controls or strategies or approaches in a very practical manner to those specific risks. Okay. What I've done to the learning is that I've added a few questions to these learning outcomes that are meant to guide and inform what we're meant to learn during this lecture. And so I'm going to read through these questions now, but at the end of the lecture, when the video is over, I want you to go back to these learning outcomes and see if you can answer any of these questions. If you're unable to answer any of these questions, then maybe you want to go back to the presentation or the area of the presentation that discusses whatever that the subject matter is. But the bottom line is that just make sure you're able to answer all of these questions, because if you're not able to answer any of these questions, then you basically haven't learned what you're supposed to learn during this lecture. So first question is, what is risk? So what do we mean when we talk about a risk? What types of risks do organizations face? What are the various sources of risks? What is the link between business objectives and risks? Okay, how is the impact and likelihood of an adverse event quantified? How do risk maps facilitate risk reporting and analysis? What is enterprise risk management? What are the components of enterprise risk management? What is the Tower framework? What is the difference between gross and net risks? How do assurance maps facilitate responses to identified risks? Okay. And again, so on a very broad level, at the end of this lecture, I want you to be able to identify risks. I want you to demonstrate that you're able to manage risks by analyzing them as well as by recommending appropriate responses. Okay, let's move on. Okay, so there are a couple of concepts which I expect will be new to you as I go through this lecture, and maybe this is a good time for us to reflect on what those specific concepts are going to be. So first of all, the idea of risk, okay, as well as the idea of risk management. Okay, so again, you would have come across risks somewhere in your past during your undergraduate studies, and you have some sort of idea of what a risk actually is, but I don't want you to take that for granted, okay? I don't want you to take that information for granted and think that you automatically understand what risk means for the purposes of this course. Risk means a very specific thing in this course, and you have to understand what that means if you're going to successfully be able to learn how to manage these risks. Okay, so we'll go through what risks mean in a minute, but for now, just realize that and take the idea or the concept of risk as a brand new concept and not something that you are familiar with. Okay, so risk and risk management will be a new concept for you. I'm going to introduce you to something called a risk register. Now, a risk register is, as I said, the Microsoft Excel template that I asked you to download. You will not necessarily, so we're going to use this risk register, okay, in a very specific way. All right, it's not something that you need to learn or that you're going to need to fill out in order to pass. Okay, however, it's a tool and a model that I want to use to show you what the main considerations are in the process of practically managing a risk. Okay, and I'll explain a bit more about that when I get to it. But another new concept is the idea of risk management frameworks, particularly enterprise risk management frameworks. Okay, again, not a bad idea for now. Before we carry on with the lecture, for you to pause this video, go on to Google, and just Google these words. Okay, just try and find out what's on the internet in terms by way of definitions. Okay, so what is risk? What is risk management? What's a risk register? And what are enterprise risk management frameworks, if you'd like to. Okay. From a content perspective, okay, I want to take you through the definition of a risk. I want to talk you through about how risks are managed. If I can just look at the time here, okay, and then I want to give you a bit of an orientation with respect to the risk management process by taking you through the risk register, like I've said. And then at the end of this lecture, I want to discuss a pre-lecture activity that I want you to complete before we have our first contact session. Okay, so let's get started. What is risk? Okay, so in order to understand what a risk is, the first thing you need to understand is why organizations exist. Okay, so you would have learned during your undergraduate studies that organizations exist to create value for their stakeholders. Okay, so the reason why a business, whether a business or a for-profit organization or a non-profit organization exists, because risk management is not confined to only for-profit organizations. Okay, we manage risks for all types of organizations, all right, including those that are not for-profit. Okay, either way, whether you're dealing with a profit making institution or an institution like a charity organization, it will exist for a specific purpose, and fundamentally the reason why these organizations exist is to create value for their stakeholders. Now, mind you, there are two concepts here that we need to break down. First of all, what do we mean when we speak about value? Okay, what is value and what is value creation? And then the other concept is stakeholders. All right, what are we talking about when we speak about our stakeholders? All right, so incidentally, the definition of value is linked to the stakeholder in question. So uh, value will depend on the type of stakeholder that we're speaking about. Now, there are different types of stakeholders, as I'm sure you are familiar with. All right, so you have shareholders. If we're referring to a for-profit organization, okay, in a business, you have a whole bunch of shareholders, okay, which are one group of stakeholders. A business will also have customers, okay, which is an example of another type of stakeholder. Um, in addition to that, something like the environment, okay, in which we operate, the communities in which a company operates, okay, those are other types of stakeholders. See if you can think about examples of other type of stakeholders. Um, Maybe the government, all right, in terms of the revenue services, okay, in our country, that will be a stakeholder, okay. You can see that, and I mean in later lectures, we will focus specifically on the idea of stakeholder and stakeholder management. But for our purposes, I think, and for the purpose of an introduction, it's enough for you to understand, um, well, in basic terms, what the various stakeholders of a business or a organization are. Okay, employees are also an example of other stakeholders within a business. Okay, now every stakeholder will have a specific interest in the company. Okay, so there's something that makes them an interest, all right, that makes them a stakeholder of the company, and that is their interest, all right, and their interest is directly linked to the impact that the company is going to have for that specific stakeholder. So if you look at shareholders, what would the interest of a shareholder be for a business? Okay, so typically shareholders have given the business some money. They will expect a return, okay, and hopefully a return on their money which is larger than that which they would have been able to generate using their own devices or their own imagination. Okay, so the shareholders' interest in a business will be to generate a return. Okay, and so if we're speaking about value creation in relation to the shareholder, then we're talking about the maximization of the return which the shareholder is going to receive at the end of the day. Okay, what is the interest of a business's customers as far as the business is concerned? Well, the customers are looking to receive either a service or purchase goods from the business, and they have certain expectations with respect to these goods or services. They want them to be of a certain quality, they want them to be of a certain specification, they want them to be fit for use, they want them to last, or whatever reason customers purchase the goods or services of a specific business, right? So that is their interest. Okay, so when you're speaking about value creation as far as customers are concerned, you are talking about giving them or meeting certain expectations, okay, of those customers. All right. What about the environment? Okay, so what is the interest of the environment as far as a business is concerned? If you think about the heavy industries in the world, so the mining concerns, the mining industries, um, they have a very direct, every business basically has a direct impact on the environment, but it's easier to understand it when you look at businesses like that. So if you also look at like fishing companies and so on, their activities have a direct impact on the environment. So it's very crucial that they understand the implications of their activities on the general environment. Okay, now the environment doesn't have a voice, unlike customers and shareholders. Okay, it doesn't really, it cannot attend annual general meetings and so on and so forth. However, whatever it is that a company does do, okay, will have an effect on the environment, and which will have an indirect effect on us, the human race. And so businesses need to be held accountable not only by somebody on behalf of the environment, okay, and that somebody has to be the shareholders, the customers, every other stakeholder that has a voice, every other stakeholder that can influence the way a business runs is crucial, right, in managing the environment, okay, or speaking up or being the voice on behalf of the environment. Okay, so maybe one day we'll have a lecture about global warming and what's actually happening as far as climate change is concerned, but most definitely there's evidence that our climate is changing, okay, and it's going to affect us in a very real and practical way in the not too distant future. And unless we start taking the things like the environment seriously and start considering, okay, as a business community, that the environment is actually a stakeholder whose expectations must also be met, then it potentially threatens the sustainability of us as a human race. Okay? But anyway, the key takeaway here is that when we are trying to understand why organizations exist, okay, we have to understand that they exist to create value for stakeholders, and the definition of value depends on the stakeholder in question. Okay, now how does this relate to the definition of risk? Well, a risk is any threat to the achievement of the objective, okay, any threat to the achievement of the objective of creating value. Okay, so anything that could potentially prevent the organization from achieving the objective of value creation for the business is a risk. Okay, so threats come in a variety of ways. Okay, so a threat can be an event. So let's think about we're an airline company, and maybe a risk event is a storm that could potentially delay or cause delays on scheduled flights. Okay, that's a threat. Okay, it's a threat because it threatens the achievement. It could potentially stop the airline, okay, from delivering the service promised to its customers. In other words, delivering the value promised to its customers. Okay, it's a unique type of threat because obviously it's beyond the control of an airline, but it's a threat nonetheless. Okay, so threats can be an event. It can be a circumstance, okay, or a condition. So if you have company A and company B, they both have the same. It's the same type. It's the same type of company. They're equal. They're equal in every other way except that they are located in different places. So let's say company A is located in a country that is prone to protests, violent protests, and a country that has a large crime rate, a country that has a lot of political instability, a country that doesn't have a consistent electricity supply. Okay, so if that country is domiciled or is located in that country, okay, it will be riskier than a country. If that company is located in a country that I've just described, it will have a higher risk profile than the same or equivalent company that's domiciled somewhere else. So the threat to the achievement of the company's objective in this instance is not coming from a specific event, but just from a condition, and that condition being where the one company is located compared to the other company. I hope you're following. Okay. So because I'm recording this video, you are unable to interrupt me as we would be able to in a class and ask me a question. However, if you do have any questions, just pause the video, jot them down on a piece of paper, and we can discuss them in class. All right, so right at the beginning of the contact session, I'll give you guys an opportunity to ask me questions arising from the lecture itself. As mentioned before, I will not be re-lecturing, all right, but I'll summarize the lecture and then you can ask me any questions if you do have any. Okay, so let's think about a couple of examples of practical examples in the real world of threats to an organization's activities. Okay, so now, and before I get into these, I want you to notice that you cannot understand what a risk is if you do not understand what the objectives from a value creation perspective of a company is. All right, so in order to understand a risk, you have to understand it within the context of the objectives of a value creating company. Okay, so let's think about this company in the public sector. It's a parastatal, meaning that it's not privately owned. It's owned by the national government. Now, the national government is essentially our, and when I say our, I'm talking about South African register, like taxpayers, all right, individuals, all right. So the national government is basically our CEO, all right. So they are the people. They are our directors, in this instance. All right, so we are their key stakeholders because the money they have, they get from our tax revenues. Okay, and they've used these tax revenues, obviously. They use them to run and administer, amongst other things, their parastatals. And we know that in the country, the management of our parastatals hasn't been very effective, to put it mildly. Okay, so in the news, we will all be aware of, or through the news, we will all be aware of all the trouble that a parastatal like Eskom is encountering. Okay, and so let's just evaluate the threats, or and understand what a threat can look like. Okay, using the example of Eskom. And like I said, you cannot understand a risk unless you understand an objective, or the value creating objective of an organization. So let's look at one objective of Telkom. It will have many, but for purpose of this example, I've just basically extricated just one. Okay, from their website, they say they have a mandate to provide. Eskom has a mandate to provide electricity in an efficient and sustainable manner. Okay, including electricity generation, transmission, distribution, and retail. Okay, so that's just the process by which electricity ends up in our houses. So they want to provide it in an efficient and sustainable manner. The company also has a development and role, promotion, transformation. Okay, blah 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 blah. All right. The main thing that I want to focus on is that first sentence. They have a mandate, or they have an objective, to create value for their stakeholders by providing electricity in an efficient and sustainable manner. A threat would be anything that could prevent them from achieving this objective. Now take a minute and think about one threat that you may have heard about in the news that could prevent Eskom from providing electricity in an efficient and sustainable manner. Okay, probably won't be too hard for you to come up with an example. So we know that there's currently rolling blackouts or load shedding. Okay, so there's already something that has happened. All right, so it's already something that's we're all experiencing, that's happening. So Eskom is unable to provide us at the moment with efficient and sustainable electricity. Okay, so but that is not the threat, that is the actual event. Okay, so that's the actual problem, the actual risk. So the risk is Eskom is unable to provide us efficient and sustainable electricity, but something is driving that risk. What is the thing that's making, or that's preventing Eskom? What is the threat? And the threat is, one example is wet coal. Okay, so the other day, just last month, we had a whole lot of rain, and the coal in which Eskom obviously uses to generate electricity got wet, and because the coal got wet, they were unable to basically generate electricity. So that's one threat. Okay, driving a specific risk, which is Eskom's inability to generate efficient and sustainable electricity. Okay, there's another threat. You could think of a couple of other threats as far as the electricity generating process is concerned. So again, the other day we heard there's some big conveyor belt that transports coal from one from where it's stored to the substation. That conveyor belt got broken. Okay, so that's another threat that's leading to the same risk event. Okay, so I'll come back to these concepts a bit later. I'm sort of preempting them and sort of overcomplicating it a little bit, but for now, just assume that you understand that there's this risk, and the risk is tied to Eskom's objective of providing efficient and sustainable electricity. The flip side of their objective is actually the risk. The risk is that Eskom is unable to provide efficient and sustainable electricity. But to manage this risk, we have to understand what could prevent them from achieving that objective, what could lead to that risk event. And the thing that could lead to that risk event, like I said, the conveyor belt didn't work, or the coal got wet, and there are other sort of threats that you could think about. And as a risk manager, you'll be required to actually think in these ways. Try and think of things that haven't happened yet that could happen, okay, so that you can manage them preemptively. Okay, maybe another threat, okay, for the same risk, i.e. the risk of not providing efficient and sustainable electricity, could be sabotage from disgruntled employees. Okay, what happens if all the employees go on strike? Okay, so that could also lead to rolling blackouts and so on and so forth. Okay, so I think you get the message from an Eskom perspective. Let's take another example from the private sector. In the international aerospace industry, I think we are all pretty much familiar with Boeing. Okay, so Boeing, if you're not familiar with them, is a company that manufactures airplanes. Okay, and their customers are governments, all right, as well as, but mainly airports and airlines. Okay, so airports and airlines are the chief customers for Boeing. Okay, I'm sure I don't need to explain Boeing's business. Okay, but let's look at one objective. Once again, coming from Boeing's website, they say, we at Boeing value human life and the well-being above all else and take action accordingly. Okay, we are personally accountable for our own safety and collectively responsible for the safety of our teammates and work places, our products and services, and the customers who depend on them. When it comes to safety, there are no competing priorities. Okay, so that is an objective. Okay, Boeing has prioritized safety, and it makes sense. If you're going to make airplanes are obviously a high risk human endeavor. Okay, we're putting people thousands and thousands and thousands of kilometers in the sky for a prolonged period, sometimes 15 hours. Okay, a lot can go wrong, and there can be a loss of human life, as Boeing has come to realize in recent history. Okay, so if you just Google Boeing, you will see there's a whole lot of news, very recent news, about airplanes which they manufactured, which ended up crashing because of some sort of manufacturing defect and not some other failure on the part of the airline. Say maybe the pilot made a mistake or something to that effect. Okay, they were actually manufacturing defects. Okay, in addition to the manufacturing defects, to compound the problem, to make it worse, okay, there were leaked emails of internal documents between Boeing employees who were making fun of the Boeing 737 MAX airplanes. Okay, so they were saying, the actual Boeing employees were saying these airplanes were actually manufactured by clowns. They can't believe that the regulators, the FIA, actually permitted these airplanes to pass all the regulatory tests and checks and assessments that are required before an airplane is allowed to be commercialized. Okay, so again, Boeing has a specific objective, and their objective is the well-being and safety of not only the passengers who end up on their planes, but also their employees, based on their website. Okay, so that's their fundamental objective. So what is the risk? The risk is that they make airplanes that don't preserve this objective. So in other words, they make airplanes that crash. Okay, it's as simple as that. They make airplanes that crash. Now, what are the threats? What are the things that could lead to this risk? Okay, faulty production. Okay, faults in the design of the airplane. Okay, insufficient risk management or quality check or quality assurance procedures, maybe inferior materials. Okay, could lead to faults on the plane, and so on and so forth. I hope you're starting to understand, one, what a risk is, and two, the relationship between a risk and a threat. Okay, so hopefully you understand what a risk is. So the next natural question is, how do we manage a risk? Okay, so it's one thing to understand what a risk is. The next thing is to understand how to go about managing a risk. There are two very important dimensions that you need to keep in mind when it comes to managing risk. Let me just check the time quickly. Okay, so there are two primary dimensions when it comes to the management of a risk. Let's get some water in here as well. Okay, the first dimension is the governance of risk management. Okay, and then the next dimension is the practice of risk management. Okay, so the governance of risk management on the one hand, as well as the practice of risk management, these two things make up the entire risk management practice. If I just take a step back and just talk about the title of the slide, I say, so we risk management, and then in brackets I have evaluation. Right. So the word management and evaluation, you will find for the purposes of this course, are used interchangeably. This word evaluate, you will find in the early chapters or the first few pages of your textbook. Okay, it's a specific verb that is used by CIMA in the assessment process. Okay, it's a very important word, and as we go on in the year, you're going to learn how important it is across all of your subjects. Okay, so I'll speak about this a bit more during our context session. However, evaluation is the highest order verb from an assessment perspective. Okay, so CIMA has a hierarchy of verbs, okay, from lower order verbs, where the idea behind those verbs is for you to just recall, okay, via memory, some information that you've acquired. All right, the higher order verbs, the higher you go, you are then expected to move from just recalling information to learning how to actually apply that information to solve a specific problem. And so the evaluation part is the highest order verb, okay? And you essentially on this course will be evaluating risks, okay? So when we assess you throughout the year, right? Assessment opportunity 1 all the way to 4, all the way to the final assessment opportunity, you will see that every assessment question will include in it a verb, and that verb is going to be a link or a cue that's meant to help you understand what the type of thinking that's required of you. In other words, are you meant to just recall and mention facts, or are you meant to actually apply what you know to solve a specific problem? Okay, I'll speak about this. It's a very important aspect, but during the context session, I will speak about this a bit more. For now, just know that risk management and risk evaluation, okay, are essentially the same thing. When I talk about the governance of risk management, I am asking you to consider two central questions. Number one, who is responsible for managing risk? In other words, who are the people that are actually responsible for managing risk? And then number two, if I can just skip that other slide, how does the board manage the risk management process? Okay. In other words, how do the people that are the people that are responsible for managing risk are the board of directors. How do they go about managing the risk management process? How do they actually manage the risk management process? Okay. So that's what the governance of risk management is all about. Who's responsible for risk management? And then how do those people who are responsible, how do they go about actually managing risk? Okay. The second dimension is the practice of managing risk. In other words, the specific techniques, the tools, the steps, the actions, the thoughts, the meetings, the documents, the actual practical aspects, the practice of going about managing risks. Okay, so if you're going to be an accomplished student for PRS in this year, you're going to need to be able to demonstrate that you understand the issues associated with both the governance of risk management as well as the practice of managing risk. Okay. So, who's responsible for managing risk within an organization? Obviously, the board of directors. Okay. I'm taking for granted that all of you are pretty clear, or you understand the way a company is structured, okay? And you understand the importance and significance of the way a company is structured in terms of the way you're meant to think about it, right? So a company, just in case some of you are not aware, which is okay if you're not, okay? That's what we're here to do. We're here to learn. The structure of a company is that, first of all, it is regarded as a separate juristic person. It has its own legal identity. So when it comes to court, you can sue a company, okay, even though the company doesn't have lungs, it doesn't have a heart, it's not human, okay, it's still obviously a juristic person, which means that it can be held accountable, and it's considered as a separate legal or separate entity, all right? And the way, as you know, you get private and you get public companies. Most of the time for PRS and for CIMA, you will be handling situations that usually face public companies, okay? What's the distinction between a private and a public company? Well, a private company or with respect to a public company, their shares, okay, or their equity is trading on a recognized stock exchange, okay, whereas a private company's shares are not trading on a recognized stock exchange. Their shares are owned by private individuals, hence it's public, it's private. Um, and I think I'm gonna stop there because I'm sure you pretty much know this stuff. I think the important thing is to realize that whether you're dealing with a private or public company, in most instances, the people who own the capital of the company are not the same people that run the company. Okay, so the capital of a company is usually split into two dimensions: one equity, and the other dimension is debt. Okay, so um, the people who actually own the capital, all right, so obviously that doesn't have an ownership interest. Okay, that's an obligation that the company has to pay back. They don't really own the company. The people that really own the company are the people that provide the company with equity capital. Okay, so they have an ownership interest. So those people are not necessarily the same people that run the company, and so you have the split between the shareholders of a company, okay, as well as the people that actually run this company, which is basically the CEO and everybody else on his management team and every other manager and every other employee within the organization. If you own shares, okay, you'll know that you don't really know what's happening on a day-to-day basis as far as that company is concerned, okay? If you own Cecil shares, okay, there are things that have already happened. Okay, so recently in the news, just yesterday, a couple of days ago, we learned that there was an explosion. There was an explosion at one of Cecil's plants in the United States. Okay, so that's public information because obviously people are reporting on the news and we've heard things. So that's what you know in the public. But there's a lot else that obviously happens in the company that you're not necessarily aware of. And this is where that whole issue of the agency problem comes in. All right, so we needed a way, okay, to bridge this information asymmetry. And the way or the device that corporates came up with to bridge the idea that you have shareholders who are investing money in companies but they don't really know what's going on a day-to-day basis, and that creates a lot of risk for them, is that we created something called a board of directors, right? So the board of directors plays a very important role in bridging the gap as far as information asymmetry is concerned between the people who are investing in the company and the people that who've invested in the company and own the company technically, and the people that actually run it. Okay, we will speak about corporate governance in another lecture, but for now, it's about what you need to know is that the board is responsible, all right, collectively responsible, not just the people on the board who are running the company, but the people on the board who are not necessarily involved in the day-to-day running of the company. The board collectively is responsible for the running of risk, for the managing of risk. But when you're dealing with listed companies, you're dealing with very large corporations, so you cannot expect a small group of individuals to manage the risks of an entire organization. So very often the board of directors will delegate the responsibility for managing risk to risk managers, okay? And these risk executive or risk managers will then also in turn delegate some responsibilities to people at the desk level, maybe risk champions or individuals at the lower levels of the company's hierarchy. So in addition to the specific employees involved in the risk management process, the board will also look to acquire independent assurance from assurance providers. Okay, so for example, the internal and external auditors. Okay, so these are not people who are so internal auditors are obviously employees within the organization, but a key thing that they're meant to retain, or a key thing about the internal audit department, is that they're meant to obviously be independent, right? So we know that the external audit is also expected to have some sort of independence, all right? So either way, the board obviously delegates some sort of not responsibility. The board doesn't delegate its responsibility for risk management to assurance providers. However, they do expect to receive some sort of assurance from these external assurance providers as well as external consultants. You will see that in your textbooks there is something called a risk map. All right, a risk map is basically something is a device that shows us the three different lines of defenses. Okay, lines of defenses that the board of directors have with respect to risk management. Okay, arising from the use of, first of all, actual managers involved, okay, in the day-to-day running of the organization, as well as these external consultants, external auditors, or the internal audit, i.e., the assurance providers. Okay. A key thing I just want to note here is that these people are not responsible for the risk management. Again, let me emphasize that they're just there to provide some or other type of assurance. Okay, so that's one key question as far as managing or as far as the governance of risk management. Okay, so understanding who is responsible for managing the risk. Okay, and then the next question is, again, how does the board go about managing the risk management process? And the answer to the question is that they will need to use some sort of framework, some sort of model. Okay, an enterprise risk management framework. Okay, which is essentially a model that companies use to manage the risks of an organization. Okay, an enterprise risk management framework, once again, it's a model, and there are several models that an organization can use, and they'll be mentioned in your textbook, so you can go ahead and read up on those. But the most popular of which is the COSO framework, the ones that are emphasized also in your textbook. The COSO framework, okay, COSO, the organization is a specific multilateral organization, okay, that comes together and issues guidance from a governance perspective, and they have a specific framework, and you would have come across that COSO cube, all right, that details. I don't have it in my slides. I'll have it at a later lecture. But essentially, this is just a framework that's used to manage risk, okay? And it's comprehensive. Right? So the idea of an enterprise risk management framework is that it's meant to be comprehensive. By comprehensive, we mean that it's meant to help the board manage risk holistically. So in other words, give the board a holistic picture, a full view picture, a bird's eye view picture of the risks involved in a specific organization, and it's meant to drive the board, okay, to create a generic risk management approach and culture across the organization, irrespective of which units and the various types of risks we're dealing with, right? So if you don't have an enterprise-wide risk management framework, your risk management tactics or techniques are going to be staggered, they're going to be inconsistent, and they're not going to be effective. So in order to be effective, the board uses a framework that obviously manages the end-to-end running of a risk management practice, or I guess within an organization, right? So yeah. All right, so again, I've mentioned the COSO framework and CIMA's risk management cycle. Okay, these are two examples of frameworks which the board can use. And then I've also listed a few advantages of an enterprise risk management framework. Some of these advantages are also advantages of managing risks in general. Okay, but other ones are specific to an ERM or enterprise risk management framework. Okay, so like I said, it keeps the bigger picture in focus. So for example, it allows the board of directors to aggregate risks and assess them at an aggregate level. So sometimes a specific business unit within a company will look at a risk and say, it's really not so important, we don't need to worry yourself about that particular risk. However, if you add that risk and to the risk which is of a similar nature, so let's say we're talking about fraud, right? So maybe for a specific business unit, the assessment is that the risk of fraud is not that significant, okay? However, when we aggregate the fraud risk in the entire organization, we may find that maybe at the individual desk level, the risk is not so important. However, when we add it up, it becomes a significant and key risk for an organization. And in this day and age, the risk of fraud is never an insignificant risk, okay? It's never an insignificant risk, especially because of automation and the digital age that we're in, okay? Human beings are finding more and more ways to, in a very intelligent manner, okay, perpetuate fraud. And so fraud is unlikely to be a non-key risk for an organization. Okay, other advantages brings risk into focus. Okay, so sometimes depending on the culture within an organization, you'll find that certain managers are prone to focusing on only the rewards and the return and the potential for upside, okay, at the expense of thinking about what could go wrong, right? So risk gives you gives you an enterprise risk management framework gives you that advantage. It facilitates planning responses for specific risks. Okay, it creates a clear link between risk management and the value creation process, like the way I've tried to do for you this morning or afternoon or evening or whenever you're watching this. And then it also improves preparedness for an uncertain future and is comprehensive, like I mentioned. Okay, so those are the considerations as far as the governance of risks are concerned. Okay, just to take you back, like I said, there are two dimensions to risk management or risk evaluation. The one is the governance of risk management, okay? And then the next one is the practice of managing risk. And that's what I want to move on to now, so the practice of managing risks. Okay. There are three elements that you need to be aware of as far as risk management practice is concerned, okay? The first element is risk identification. The second is risk analysis, and the third is risk response. Okay, you cannot be considered to be managing a risk unless you have addressed each of these three dimensions or three elements: risk identification, risk analysis, and risk response. What do we mean when we speak about risk identification? Firstly, we're talking about putting the various risks of an organization into categories. In other words, putting them into buckets. Okay. Event description. Okay, so another thing that we do when we are identifying a risk is that we articulate it in terms of an event, the way I did with respect to ESCOM. And usually the event that you're going to describe is the threat. Okay, so we know that the risk in the ESCOM example, the risk is interrupted electricity supply. Okay, so that's the risk. There's a risk that they are unable to provide electricity on a consistent basis. Okay, and the electricity supply is interrupted. Okay, but the event that you're describing would be a conveyor belt breaks down, or like we said, the coal gets wet, etc. Okay. Okay, so, all right, I'm going to take a step back there for a second and just try and clarify. And maybe without, let me not get into too much detail here, because all of these elements actually exist in the risk register. I'll explain it in a bit more detail when we get to the risk register, because I think you're going to get confused between what do we describe as an event and what do we say as far as causes are concerned and consequences. But all you need to know for now is that when we're speaking about risk identification, okay, we're speaking about categorizing risks, putting them in specific categories. We're speaking about describing a specific risk event, describing what caused the risk event, as well as describing consequences of that specific risk. Okay. The next phase or the next element is risk analysis, and risk analysis involves describing the impact of a risk as well as the likelihood of a risk. Okay. By impact, we're trying to know, will this be a high impact risk? Or will it be a medium impact risk, or will it be a low impact risk? Okay, and there are a few things that we need to take into consideration when we're trying to reach that conclusion, and we'll go through it in a minute. Okay, the next thing we want to think about is the likelihood. So in other words, what are the chances of this risk occurring? Okay, so as you will see in a minute, a risk becomes very, very important. Okay, an identified risk becomes very, very important and must be closely monitored and managed by an organization if it has the potential to have a high impact, actually not or, so high impact and high likelihood. Okay, so some risk will have a high impact and high likelihood. So the chances of this risk happening are very, very high, and if the risk actually happened, if it was realized, it would have a very large impact on the organization. Such a risk obviously becomes a very key or a significant risk. Okay. At the opposite end of the spectrum, there's some risks which will have a low impact even if they happen, and they have a very low likelihood of happening. Okay, so such risks are important but less important than the other risks. Okay, so these are type of risks where the board may take decisions like let's not do anything about it, we'll just monitor it. Okay, and then that naturally brings us into the third dimension, which is responding to a risk. Okay, so once you've identified a risk, once you've analyzed it, and basically once you've analyzed all of your risk and um, uh, um, once you've sorted them, right, by order of importance. So that's the whole point of a risk analysis. Okay, so you want to create some sort of sort so that you can prioritize the most important or the imminent threats for an organization, right? So once you've done that, the last and logical thing to do is to create a response. Okay, so in summary, there are three dimensions as far as the risk management practice is concerned. Okay, the first one is risk identification, analysis, and response. Okay, now that we've gone through all of those, it's time for us to walk through a risk register. Okay, and I said at the top of this video that I was going to use this risk register in a particular way. Okay, so a risk register is a practical tool that's used by businesses, okay, to manage risks. For the purposes of this course, the most important thing about this risk register is learning the variables, the various things that are in the risk register, because these are going to inform the way you think about risks, the way you think about the practice of managing risk. Okay, so you don't have to worry about memorizing the model. And apart from the way we're going to use it in class and the various activities that you're going to do for me, as far as the risk register, using the risk register, apart from that, you don't have to worry. All you need to focus on is the variables that I'm going to point out in a second. Okay, don't have to worry about the actual risk register itself. Okay, so maybe you can pause the video now. Let us find that risk register template that I've made available for you online. Okay, just want to see if you can. Okay, so if I look at how you are seeing this risk register, I don't think, okay, I'm going to try and make it as big as I can, okay, so that you can see it, but I strongly advise that you don't just sit back and watch this video as we go through this thing. Try and pick up and open the document and try and familiarize yourself with it. Okay, so first things first, you will see that there are headings in row number 3, okay? And these headings have the 3 dimensions or elements that we've just discussed. Okay, the first one being risk identification. Okay, the next one is risk assessment. Okay, and then the last one, like we mentioned, is risk response. Now there's an additional one here because it's a practical tool that's used in business. Okay, so there'll be a few more things, some of which I've actually deleted. You'll have something about risk monitoring and review. This is where once we've basically got a risk on our radar and we've analyzed it and prioritized it and we've generated a plan for responding to this risk, we want to make sure that we can monitor the progress that's been made and keep reevaluating the risk to see if a risk has become less important or more important. Okay, so that makes sense, but it's not something that you're going to be required to demonstrate on the degree. Okay, so your focus is going to be on, like I said, the identification, the assessment, as well as the risk response. Okay, so you'll see that at the bottom I have a whole lot of input sheets, okay, all of them dealing with some aspect of the 3 dimensions. Okay, so let's get started with risk identification. Okay, like I said, when we are identifying a risk, we are concerned about 4 things. Number 1, we want to describe or put this risk in a specific risk category. Okay, the next thing we want to do is describe the risk in terms of an event. Okay, and then the next thing we want to do is describe what could cause the risk to happen, and then the last thing we want to do is describe the consequence of the risk. So what could happen, what will the impact of the risk be? Okay, so if this risk happened, what will the consequences or implications of it be? Okay, I already have an example that I'm using Eskom's electricity supply, which we'll fill out in a minute, but for now I just want to go back to the slides and I just want to talk about the different categories of risk. Okay, so um, SEMA uses four broad brackets or buckets, okay, as far as risk categories are concerned. Now, putting risks into categories is a very meaningful thing to do because obviously it facilitates the different types of risks warrant different types of responses. And so, if you have a specific bucket, okay, you'll essentially, it makes it easier for you to now generate ideas about responses. Yes, facilitates the risk management process and is important for actually articulating what the risk is. Okay, so the different buckets are firstly strategic risks. Okay, these are the most important risks. Okay, because they stem from the entity's strategy. Okay, and pose the greatest threat to the achievement of that strategy. Okay, so you will be doing a lot of business strategy stuff with Adele. Okay, so I mean we're not doing strategy here, but that is a very important subject. Okay, and in actual fact, um, it is it's the fundamental subject that links and connects every other subject. Okay, so if you wanted to rank the three subjects that you have this year, PRS, FS, and MAS by order of importance, MAS is probably the most important subject that you have. Not that the other ones are not important, but MAS, if you do well in MAS, it puts you in a very strong position to do well in all the other subjects too, because you are at the strategic level, okay, of SEMA's qualifications framework, okay, and so um, um, the business strategy is basically where you're going to do most of your learning, and hopefully you'll be able to apply some of what you learn in MAS in a subject, especially like PRS, and where the integration is obvious. I'm going to point it out as we go through the lectures throughout the year. Okay, so strategic risks are the risks associated with the choices that we've made from a strategic perspective, and there are a variety of things to consider, like I said, that you're going to explore in MAS from a strategic perspective. They are the most important risks because if we don't manage these risks, okay, it threatens the sustainability of the organization. Okay. Financial risks is the other bucket. Okay, so they relate to the financial operations of the entity. Operational risks are risks relating to activities which we carry out within an activity. Okay, so I'll give you an example of each risk just now. Let's just define them. A hazard risk are risks that may occur due to political, economic, social, cultural, technological, environmental, and legal changes. Okay, so let's go through an example of each. A strategic risk would be risk associated, would be, for example, country risk. Okay, in fact, let's go back to the risk register. I just want to take you back to the risk register for a minute, and let's go to this identification tab. Sorry for bouncing up and down like that, but hopefully you are still with me. Okay, so in this identification tab on the risk register, okay, I have the broad brackets that I've just described. Here are the strategic risks. Here are some financial risks. Here are some operational risks, okay, as well as hazard risks, okay. And then I have some unclassified risks, which is an exercise which I want you to basically classify them at some stage, okay? We'll go through that in just a minute, okay? So here are some examples of strategic risk. Corporate governance risk, okay? The risk that insiders, okay, you can't really see that too much. Okay, I hope that's better. The risk that insiders or employees won't act in the best interest of owners or shareholders and the community, okay? Competition risk, the general risk that you lose out to the competition, okay? Innovation risk, the risk that the competition will out innovate you, okay, is an example of a strategic risk, okay? What else is in here? Reputational risk, the risk of damage to your corporate image. Reputation risk can reduce trust in your business and lead to destruction of value. Now, the thing to notice about all of these risks is that they will affect affect the company as a whole. Okay, so they will affect every single division, business unit, subsidiary, branch of an organization. Okay, so if you if at the corporate, if at the board level, all right, you have individuals there that are not acting in the best interest of the company, but within in their own interest, okay, by committing fraud or any type activities, okay, that's going to affect ultimately the entire business. Okay, and we have a few corporate scandals that have happened in the last couple of years that have shown where CEOs and CFOs were involved with some sort of fraud, which resulted in layoffs of people at very, very low levels of the organization. Okay, so that's why strategic risks are so important, because they affect everything. They affect the entire business as a whole. Right? So we have to keep an eye on these risks. Okay, compliance and legal risks are a subcategory of strategic risks. They just relate. They relate more to legalities. And again, if you are operating within a country, within a region, it has specific laws. If you don't comply by those laws, there's a chance that the regulators, just like Boeing is learning, the regulators can disrupt your operations, because those 737 MAX airplanes that they produced were grounded. Okay, meaning that they've made all of hundreds and hundreds of airplanes, which costs billions and billions of dollars, but they're unable, obviously, to recover them because they can't sell them yet. And it doesn't look like the FIA, because of those leaked internal emails, is going to approve those airplanes. We don't know. Okay, don't know what's going to happen. Okay. So here are a few examples of some financial risks. Okay, profit risk. The general risk that profits will fall. Check out the time quickly. Okay, so profit risk is a risk that profits will fall. Interest rate risk, the risk that interest rates will change in a way that's unfavorable for your business. Investment risk, the risk of a change in the value of an investment. Okay, so you can go through these all on your own, but basically these are examples of the type of financial risks that a company will encounter. They are different from strategic risks in that they essentially only impact the finances of the company. Okay, they impact either our revenues, our expenses, they impact our investments, etc., etc., etc. If you look at all of them. Okay. Operational risks, likewise, impact or will only have an impact on the operations of a business. Okay. Okay, within operation risk, I have information technology, which has become obviously a key thing in this day and age because of digitization and the fourth industrial revolution. Okay, so you need to be wary of the way you design your information systems, especially with respect to information security or cyber risk, okay, which is a specific section that we will be going through this year. And then you get hazard risks. Okay, so we have strategic risks, financial risk, operational risk, as well as hazard risk. Hazards are basically things like acts of nature, war, terrorism, so large-scale, high-impact events that don't happen every other day, but when they do happen, they have very significant or serious repercussions. Okay, political risk. Okay, so the risk associated with a change in regime. Okay, high-impact stuff. All right. So now, what I want you to do is pause this video, and then on the side here, I want you to classify the following unclassified risks. Okay, so just write down what you think each of these risks are. Is it a financial risk? Is it an operational risk? Is it a hazard risk? Okay, or is it a strategic risk? Okay, so pause the video now, and in a few minutes I will reveal to you the correct answers. Okay, so you can compare your classifications to mine and just make sure that you got every one of them right. And for the ones you didn't get right and that you still don't understand why you didn't get right, maybe we can have a discussion about them in class. Okay, so let us move on. We don't have a lot of time remaining. So again, the risk category bracket is all about classifying risk and deciding whether it's operational, financial, strategic, hazard. Okay, so I'll come back to the classification just now. The next thing is we want to describe the risk as an event. Okay, so I've taken the Eskom example and I've described a specific risk event, and the risk event in question is disruption in electricity supply, which is the one that we've been speaking about. Now notice that again, the way I came up with this risk by flipping Eskom's objective or mandate around. Okay, so their mandate is to provide consistent electricity. Okay, and the flip side of that is that there's some sort of disruption. Okay, so the event is that something is going to cause a disruption in the electricity supply. Right. So that's the risk event. What could be causing this risk? Well, I went through a few examples. Okay. But I described wet coals on account of rainy weather is one example, okay? But we could easily add in there let's say improper asset maintenance, okay? Conveyor belt breakdown. Okay, that could be another cause, okay, of the same risk event, i.e., both things. These are the threats that I referred to earlier on. All right, so the threats are effectively what's causing or driving our risk event. Okay, so improper asset maintenance. Okay, and then the next thing we want to describe when we're describing a risk is the consequence. All right, so what is the consequence of disrupted electricity supply for Eskom? Well, now, it's very important for you to realize that we're looking at it from the business's perspective, okay? So, because there's always a temptation to think about the consequences for us, the consumers, or any other stakeholder, all right? So we don't care, not that we don't care about necessarily the stakeholders, but we're not looking at it from the perspective of the stakeholder. Because if you were looking at it from the perspective of the customers, for example, then the consequences you'd be putting in here would be, I can't wash my clothes, or I couldn't study, or you know what I mean. So or maybe there's a hair salon business and they couldn't have customers today because they didn't have electricity, or whatever the case may be. We're not looking at it from the customer's perspective, we're looking at it from the business organization's perspective, from Eskom's perspective. That's very key. Okay, so what would be the consequence of a disruption in electricity supply for Eskom? Well, they're going to lose out on revenue, okay, because whatever electricity they haven't generated, anytime there's no electricity, they're not making money. And not only are they not making money, they're spending money, because usually they have to spend additional resources in order to fix the conveyor belts, in order to get coal that's dry, or whatever the case may be. All right, so there's a loss of revenue, and that lost time, because of the nature of their business, they can never make back. Right, whatever time, any moment they did not generate electricity, they lost out. Okay, and also their reputation. Okay, so if there's one organization that's not favored in South Africa at the moment, it's probably Eskom. Right. So when we talk about identifying a risk, this is what we're referring to. Okay, so as far as the risk category is concerned, okay, so now we can go backwards and decide this risk that we're describing, the disruption in electricity supply. Is it a strategic risk? Okay, so does it emanate from their strategy? No, it doesn't. Okay, so it's not because of some sort of strategic decision that Eskom is having electricity supply issues. Although it can be argued that maybe if Eskom were to be privatized and they followed that strategy, okay, the strategy similar to Telkom, okay, which has the government as a significant shareholder, but then the rest of their shares are privatized, maybe then it would create a more consistent electricity supply. So that's an argument that could be made. But at this stage, if you wanted to manage this risk, you couldn't categorize it as a strategic risk, because I suppose you can, but we are trying to manage the imminent issue of disruptions in electricity. Okay, and in order to do that, you need to classify it as an operational risk. Okay. Is it a financial risk? No, it's not a financial risk, because it's not something related to our finances. Okay, we're not, unless we're describing a cause to this risk that's related to our finances. So it's because we didn't have money that something like that happened. Maybe we're describing a financial risk, but a risk associated with a disruption in electricity for Eskom is an operational issue. Okay, all right, cool. So that's what risk identification is all about. Let's go through risk assessment. let's go through some risk assessment. Okay, so when you are assessing a risk, you're talking about, like I described earlier, you're talking about assessing the impact as well as the likelihood of the risk. Okay, yeah, we're talking about the impact as well as the likelihood of a risk, and you must remember we have a risk rating column here, and the reason why we have a risk rating column is because the whole point of a risk assessment or risk analysis is to prioritize risks, okay, to decide which ones are the most important and which ones are the least important. Okay, and so we need to the result of this exercise of looking at the impact and likelihood needs to result in some sort of rating. All right, so now once we have a rating, we've looked at the impact and the likelihood of the risk, we'll have a rating. The next thing to think about is to assess our our existing controls. Okay, so do we have any existing controls in the organization that address this risk? And if the answer is yes, we do, then we want to evaluate the effectiveness of this control so that we can decide on a net risk. Okay, so in this section we're deciding on the gross risks. Okay, and here we are trying to describe the net risks. Okay, and again, with the net risks, we're assessing the impact after consideration of existing controls, the likelihood of the risk happening after consideration of the existing controls, and if nothing is changed, then the rating doesn't change. However, if we think that there are some controls that are going to effectively manage, that are going to help us effectively manage this risk, even though we might have thought on a gross level, okay, on a gross level, this risk is very important, on a net level, on a net basis, we might decide that it's maybe less important. Okay, so before we move on, I just want to show you in these tabs some of the aspects that we consider when we're considering the impact of a risk. Okay, so assessment of impact. Okay, now in this row over here are all the dimensions that we might want to consider in making a determination about whether or not we think a risk is significant, or at the opposite end it is insignificant, or something in between, like it's major or moderate or minor. Okay, so the classifications don't really matter, and you don't have to memorize any of these classifications as long as you're able to tell me whether you think a risk has a high impact or a low impact rating, or it's going to be moderate. Okay, so what are the things that we need to think about, or what are the variables that we can think about when we're trying to decide if a risk or trying to assign a rating to a risk? Okay, so we can think about it from a financial perspective. Okay, so if a risk has a financial consequence, all right, then we can create brackets. So we can say, depending on the risk appetite, okay, that the board has set, in other words, the amount of risk that the company is willing to tolerate, okay, they can decide that any risks above 100 million rand are significant, or maybe risks between 75 million and 100 million rands are major, and maybe the cutoff for insignificance is that any risk that has a financial consequence that's less than 25 million rand, okay, is insignificant. Now that's one consideration. Usually when you're dealing with a risk, you cannot look at just one dimension, because a risk will not just only have a financial consequence, it's going to have multiple consequences. Sometimes it will affect our reputation, just like with the risk of the electricity supply disruptions for Eskom, right? So there will be financial considerations, but there will also be reputational considerations, and we need to analyze this in a very dynamic way and put together our analysis to come to some sort of impact rating. So in other words, maybe the financial consequences from an Eskom perspective of electricity supply means that we've calculated it and we think the financial impact is going to make it a significant risk. However, maybe from a reputational perspective, maybe we don't think that it's a significant risk for some reason, we think it's a major risk. Although in this example, I think it's fair to assume that from a reputational perspective, there's going to be massive and sustained impact on the corporate reputation of Eskom, and it's going to be very difficult for them to recover. All right, so so we know that electricity supply from an Eskom perspective is going to have a financial consequence. Will it have a consequence as far as the regulator is concerned? Is there threat of enforcement is a threat of any regulatory action? Not really. Okay, so this is not going to be a real issue as far as, because they're not breaching any law, they're not breaking anything. It's just the business being run badly. So there's probably not going to be any regulatory, there's probably not going to be any legal repercussions. There will be reputational consequences. There will be consequences associated with the customers, us, and their corporates, of course. And it's probably going to be significant as far as the customers are concerned. Let's just read what is meant by significant. Okay, so for the risk to be significant from a customer perspective, it must have extensive and systemic impact on the customer base. The event results in mass outflow of customers and investments, and the company faces problems to attract new customers. Actually, the Eskom is a very interesting case because they are basically, they have a monopoly as far as electricity generation is concerned in South Africa. There are a few private players in the space at different point of the value chain. However, Eskom still owns the monopoly, right? And so even though okay, from a reputation perspective, the customers obviously are not going to be happy with Eskom, the impact, okay, on the customers in terms of them leaving Eskom or not purchasing Eskom services is probably not going to be significant. It's going to be insignificant. It's going to be negligible because the customers don't have options. Okay, so there's no competition. However, if there was competition, if we're dealing with a different risk for Eskom or dealing with a different company, then maybe this risk, the customer dimension or the customer variable would have suggested that this is a significant risk. Okay, so we do this. So we don't only consider customers, we consider people, in other words, the staff, we consider reporting requirements, and any other thing which may not be mentioned in this model that you think is important in assessing the impact of a risk. Okay. Often for PRS, you will be given a scenario. Okay, the assessment is going to work in that you'll be given a scenario. Okay, you're going to need to read through the scenario. Okay, and basically your role as a risk manager or risk evaluator is to identify the elements which are important. Okay, or the elements or the variables which I alluded to in the scenario, okay, that make a risk important or not so important. We'll go through a practical example of this during class. All right, so for purposes of our example, we think that this is a significant risk. Okay, the risk of a disruption in electricity supply is a very important risk for us because of the financial consequences, let's say. The next thing we need to decide is the likelihood of this risk. Okay, so when it comes to likelihood, it's all about determining probabilities. Okay, so what is the probability of the risk happening? All right, so if we decide that the likelihood or probability is between 90 and 100%, and probability is all about the frequency of historical data. So how many times has something like this happened in the past, right? And that probability, that's what we use to basically decide a probability. Okay, so it's almost certain if it has a 90 to 100% probability, or it's rare if it's a 0 to 25% probability. Okay, so with respect to our example, okay, disruptions to the electricity supply is probably almost a certainty just based on the frequency of it in the last decade. Okay, Eskom has been rolling out blackouts for more than a decade now, and so it's almost a certainty that definitely there's going to be disruptions in the electricity supply. All right, so the probability is within the range of 90 to 100% probably. Okay, so if I go back to my register, I said for probability purposes, it's almost a certainty, and there's a specific map. Okay, so rating matrix, there's a map which has impact on the y-axis and likelihood on the x-axis. Okay, and depending on the decisions we make as far as impact is concerned, so now for our risk, we've decided that it's a significant risk. Okay, so it's lying basically on that on that axis. Okay, from an impact perspective, but we've also decided that the likelihood of this risk happening is also very, very high, almost certain. Okay, so it's basically lying in that cross section. So that's the rating for it. So for this specific company that uses this risk register, this rating, the rating for this risk will be VH VH25, and the board knows that every VH25 risk is high priority risk. Okay, so anytime there is a meeting or discussion at every management meeting and every AGM, this is the risk that basically gets given priority. Okay, so we are almost done. The next thing is to consider existing controls. All right, so we know from what we read about Eskom that the way they manage wet coals. Okay, so if we just focus on wet coals, that the existing controls for wet coals is stockpiling and stockpile management. So in other words, if we know they have a system where if they know that there's a possibility of rain, then they start to stockpile their coal and keep it in a place where it can stay dry, okay, so that they're able to supplement the coal that's wet to prevent the disruption in electricity, okay. So we know that we can maybe mention that as an example of an existing control, okay. Now we need to assess the effectiveness of this control, and based on the fact that we have such regular load shedding, we know that this control is probably inadequate, okay. So that's our justification, and so therefore our net risk analysis will stay the same. In other words, the impact will still be high, okay. From a financial perspective, the impact will stay the same. Will still be high because this risk is not addressing our issues. Because this control, is not addressing the risk adequately enough, and the likelihood is also going to stay the same, right? So sometimes, depending on the control, it may reduce the impact or it may reduce the likelihood. Okay, so the risk rating on a net basis stays the same. Okay. Okay, so now there's an aspect here related to risk appetite. Okay. So let's just go to the risk appetite tab. So we have blue, green, amber, and red, like a traffic light. Okay, except maybe it has one extra color. And we use this basically to, it says that depending on the nature of the risk, the following options are available. So if we decide that the net risk exposure is excessive given the desired exposure, management intervention is required immediately to reduce the exposure. So we use basically this risk appetite, the risk appetite tab, to decide what needs the urgent attention of management. Okay, so and again, it's just another way for us to prioritize risks using the risk appetite. The risk appetite of an organization will depend on the judgment of the people running the organization, and maybe sometimes also the nature of the organization. Okay, so some organizations like space exploration companies, okay, like SpaceX, okay, they will have a much higher risk appetite because they're obviously involved in much higher, actually, their risk appetite will be much lower, okay, because one simple mistake can cause serious repercussions and have much larger financial and human impacts than, for say, a retailer in Johannesburg, say a Pick n Pay or ShopRite or whatever the case may be. Okay, so the risk appetite for a company like Pick n Pay from a human safety perspective will probably be higher. They can take on a few more risks, okay, as opposed to a company like SpaceX. They can't afford to take on too much risk. They will set a very low risk appetite. So just be careful that you understand that relationship. Okay. Risk response. Okay, so how are we going to respond to this risk? Now, when it comes to responding to risks, there is something called the TOWER framework. Okay, so TOWER is just a mnemonic that stands for transfer, avoid, reduce, or accept. Okay, so some risks we can transfer contractually. So let's say we have a contractor. We've hired an external consultant to come and take care of something for us at Eskom. So maybe they're responsible for managing the conveyor belts. Okay, so we can put together a service level agreement as Eskom's management and transfer the risk of the consistent operation of that conveyor belt to them, so that if that conveyor belt that transports the coal gets broken, whatever financial repercussions they need to pay for. Okay. The other way to transfer a risk is via insurance. Okay, so you sign a contract with an insurer, and you say in the event that there's disruption in electricity supply, you will pay us we will pay you a premium monthly, but in the event something like that happens, it will be a very, very high premium in this day and age, obviously. But you will pay a premium in the event that something happens, you will be required to pay us out. Okay, so that's what it means to transfer a risk. Some risks, if they're too much, if they're too high, we need to avoid. Unfortunately, if Eskom's primary mandate is to provide electricity, and even though disruptions in electricity is a very, very high risk, they unfortunately cannot avoid it because they would be they'd be avoiding their enterprise as a whole, right? But there are some risks that can be avoided. So let's say there's a new venture, okay, that, or a new innovation, okay, that could potentially, I don't know, something that's not related to Eskom's main business, right? They can invest in some sort of activity that could generate money for them to supplement the money they're losing from their normal day-to-day business. Okay, so if the risks associated with that venture are assessed to be too high, okay, they would want to avoid. So termination or avoidance of the risk related to a specific activity. Okay, so avoidance usually happens for high impact, high likelihood risks. Okay, which are not necessarily related to the day-to-day functioning of the business. Or they can reduce the risk, so they can take actions, implement a few controls to make sure that the risk comes under control, or just accept it. Okay, so if you're dealing with a low impact, low likelihood risk, or even a moderate impact, a low likelihood risks, those risks in between, some of these risks, we just need to live with them. There's nothing to be done. Just accept it as part of the day-to-day risk of a business. And a lot of hazard risks are good examples of this. If we have a company that's located in a place that's prone to earthquakes and natural disasters, okay, if there's no insurance contract that we can use to cover our costs, but let's say we are mining some sort of material that's only available in that location and we cannot avoid being in that location, and there's no control that you can put in place to stop a natural disaster, and let's assume that there isn't any control that we can put in place to mitigate the effect of the natural disaster because of whatever technical reason, then maybe we may have to just accept that risk in that event. Okay, so that's it from a risk response perspective. Okay, in this block, I've basically written a few steps that can be taken to address the risk that we're using in our example. So perhaps we can assess the competency of the operations manager, specifically in the area of stockpile management. Consider hiring new and more qualified personnel. Review and update the contingency plan to ensure that it includes an assessment of expected downpour, in other words, rain, and details procedures to ensure that coal does not get wet. How you write a risk response, it doesn't matter. What matters is that whatever we're writing or the recommendations that we're making must always be practical. Okay, so reviewing and updating our contingency plan to make sure that we include an assessment of when it's going to rain, or there are specific procedures to ensure that coal does not get wet, or we can try and implement or alternatively try and make sure that there are enough stockpiles, okay, to cover ourselves in the event that maybe coal gets wet. All right, so that's a specific implementable thing. I'm not describing it in specific details. I'm just saying let's do something to stop what's causing our risk. You must notice that, because to be able to describe what Eskom must do in very, very specific details to address the risk of electricity supply disruption, I would have to be an engineer, right? I would have to know a whole lot about how electricity gets generated. Now, I don't know much about how electricity gets generated, but I know from a very base level, a very high level assessment of what's causing the risk, wet coals, right? And high level assessment, as in I read it in the news. From that high level assessment, I'm able to make a determination as to the correct actions to be taken. And so if what's causing the risk is wet coals, well, let's try and do stuff to make sure that our coal doesn't get wet. And that's all you as a postgraduate student need to understand. Otherwise, we would have to make you an expert in the managing of this risk. Okay, so that brings us to the end of the lecture. I will post a separate announcement on Ulink with respect to the pre-lecture activity, and you can get more information then. Thank you.